Hello, fellow seekers of knowledge, and welcome back to the Psych HR Geek, the one-stop shop for unraveling the enigmas of our fascinating world. Today we're unveiling part 2 of the mysterious world of financial psychology, and if you didn't catch part 1, make sure to go back and watch it first. But before we dive in, make sure to hit that like button, subscribe, and ring the notification bell so you won't miss any of our enlightening content. Through your support, we can continue to bring you eye-opening and enlightening content. Again, so much enlightening content. Thank you for returning to part 2. Let's kick things off by discussing one of the richest dudes in the world, Bill Gates, William Gates Jr. the First. Just kidding, made that up. A fun fact about Bill Gates' wealth: as of October 2021, Bill Gates' net worth was estimated at $132.7 billion. Billion with a B. To illustrate how rich Bill Gates is, or was, he's probably richer now, imagine you make 132 grand on an annual basis. Even if you don't spend any of it, you'll need 1,000,000 years to reach that number, that 132.7 billion number. So, you got that going for you. Me too. Bill Gates once dropped wisdom on us. Success don't make a great teacher. He actually said success doesn't make a great teacher, but I need to get something in somewhere. It's like success pulls a Jedi mind trick on smart folks, blinding them to the role of luck and making them think they're invincible. But guess what? That's a surefire way to end up on the losing side. So, how do you factor in luck when dealing with your finances? Well, don't go stalking individuals as your role models. When you pick outliers like billionaires who've reshaped the world, you're asking for trouble. Here's the deal. John D. Rockefeller, a business heavyweight, had a habit of thumping his nose. Oh, that's thumbing. I guess you could thump your nose at someone too, although I don't know what that looks like. Maybe that's like an elephant banging its trunk around. I don't know. Had a habit of thumbing his nose at the law when he built his petroleum empire. We might applaud that today, but if he flopped, we'd be calling him an unsuccessful crook. Luck played a big role there. Trying to copy someone's success like Warren Buffett's moves is like trying to catch lightning in a bottle. You can't guarantee the same outcome. Instead, focus on patterns of success and failure. The more common a pattern, the better your chances of applying it to your own life and money decisions. For instance, studies show that folks who structure their days are happier with their work. Unlike the wild success stories, that's a practical nugget you can put to use right now. And if you didn't already know, envy can turn you into a financial daredevil. Which brings us to capitalism. The champ of wealth creation also happens to be a pro at stirring up envy. Picture this, a rookie ball player hauling in $500,000 a year. And I'm talking cash, not wildlife. By normal standards, he's living the high life. But toss him on the same team as a superstar like Mike Trout, who rakes in $36 million, and suddenly he's not feeling so hot about his earnings. He's got a case of the "I want what they have" blues. Meanwhile, big earners like Trout are eyeballing the even bigger fish in the pond. To crack the top 10 highest paid hedge fund managers in 2018, you needed to pull in a mind-boggling $340 million. That makes Trout look like a minnow. Now, from a moral standpoint, envy isn't really frowned upon in capitalism, but it does raise a red flag, practically speaking. Bottom line, envy can lead to risky moves. Let's chat about Rajat Gupta for a minute. Starting out in the slums of Kolkata, he climbed to the corporate ladder to become McKinsey's CEO and was sitting on $100 million. Again, cash, not wildlife, when he retired in 2007. Pretty darn impressive, right? Oh, my friends, you know us well enough by now to know that there's a twist coming. Rajat Gupta got envious, aiming for billionaire status. When he got wind of Warren Buffett dropping $5 billion to save Goldman Sachs during the financial meltdown, Gupta pulled an illegal insider trading stunt, pocketing an easy million. His dodgy deals piled up to $17 million before the law came knocking, and he ended up with a hefty prison sentence. Moral of the story: envy can steer you towards terrible decisions, and the price tag on those decisions can be way higher than the gains. Think of it this way: gorging until you're sick isn't worth it. Leaving some opportunities on the table isn't a loss. It's a sign that trying to grab everything can lead to major regrets. In a nutshell, don't go full Rajat Gupta. Never go full Rajat Gupta. Making money is easier than keeping money. My partner's Lego collection would agree. Meet Jesse Livermore, one of the most brilliant stock market traders in early 20th century America. By the age of 30, he was worth a staggering $100 million in today's dollars. Just before the stock market crash of 1929, Livermore made a monumental decision. He bet against the market, predicting a decline. His gamble paid off handsomely as the market plummeted. You'd think he'd lived happily ever after, right? Well, not quite. Success, it seems, can be a deceiving teacher. After his triumph in 1929, Livermore thought he was invincible. Are we seeing a trend here? Invincibility. It's only meant for Superman. Technically, he had kryptonite, though, so I guess he wasn't completely invincible, but I digress. Let's see, we were talking about Livermore. Livermore began making riskier and riskier bets, leading to massive losses. Eventually, his fortune evaporated, and in 1940, he tragically took his own life. Our key takeaway here is that amassing wealth is one thing, keeping hold of it is another story altogether. Making money is all about risk, optimism, and courage, but keeping money, that's a different psychological ballgame. It's about the fear that everything you've earned could vanish in the blink of an eye. It's about humility, recognizing that success isn't solely a result of genius, but also of luck. So, how do you safeguard your wealth? In a word, perseverance. Entrepreneurs who thrive are those who stick around for the long haul, who learn from their mistakes, and who fear losing what they've built. After all, when you're scared of losing, you approach potential wins with a different perspective. Few gains are worth risking everything you've worked for. Finally, let's uncover a remarkable truth. You can be wrong half the time and still make a fortune. Meet Heinz Berggruen, who, in his early life, showed little promise. Forced to flee Nazi Germany in 1936, he embarked on an uncertain journey. Heinz studied literature at the University of California, Berkeley, and dabbled in journalism, all while nurturing an unlikely passion for modern art. In 1940, he took a $100 gamble and purchased a small watercolor painting by the artist Paul Klee. This marked the beginning of a lifelong fascination with art. Fast forward to the 1990s, and Heinz Berggruen had evolved into one of the most successful art collectors in history. In 2000, he sold his magnificent collection to the German government for €1 million. Remarkable considering it was estimated to be worth about $1 billion. So, what's the secret to Berggruen's astounding success in the art world? The investment firm Horizon Research has an intriguing theory. According to their research, oops, I did it again, another spreadsheet, sorry! All great collectors share a common strategy. They acquire vast quantities of art. Some pieces turn out to be lucrative investments, especially if held for an extended period, but the majority are, in essence, duds. The key lies in persisting with successful investments until the overall return of the entire collection aligns with the best performing elements. In essence, Berggruen's collection resembled an index fund. His risks were spread across a wide spectrum of investments. Instead of only buying pieces he personally admired, he acquired everything he could lay his hands on and patiently waited for the stars to align. This strategy applies not only to art, but to all forms of investments. It's like embracing the concept of the long tail, where a small number of events significantly influence the majority of outcomes. In simpler terms, when you get a few things right, you can afford to get more things wrong. Failure is inevitable. What truly matters are the nature of your successes. So whether you're sitting on a Picasso or holding on to 99 duds in your collection, remember that diversification and perseverance can lead to financial success. To sum it up, the psychology of money is a complex dance between our personal experiences, the role of luck, and our decision making. It's a reminder that we should remain humble about what we know and acknowledge the role of chance in our lives. Envy, though a powerful motivator, can often lead us down the wrong path, and a desire to keep up with others can result in costly mistakes. When it comes to preserving wealth, remember that maintaining success can be even more challenging than achieving it. Perseverance and a healthy fear of losing what you've earned are your best allies. However, don't ever let it compromise your health, your mental health, or the health of others. If you ever feel the need to step back, it's probably best to do so. And embrace the idea that you can be wrong sometimes and still achieve financial prosperity. It's not about avoiding mistakes, but about making the right calls when it truly counts. Peace out, Part 2. Before we wrap things up, I'd like to give a huge shout out to our incredible subscribers. You truly make our world shine. Make sure to show your appreciation by hitting that like button if you found this intellectually stimulating journey enjoyable. And if you haven't already, don't forget to subscribe to our channel for more captivating content. Also, we're all ears. Are you eager for more content in a similar vein? Feel free to share your thoughts in the comment section below. Thanks for joining us on this journey through the psychology of money. We hope you've gained some valuable insights into the complex relationship between human behavior and finance. For those of you who crave a deeper dive into this subject, the link in the description is your gateway. And always remember, your active involvement keeps our channel vibrant, so go ahead and spread the love. As always, stay curious, stay wise, and stay financially savvy. This is the Psych HR Geek signing off.